My name is Andrew Wilson. I'm the co-president of the Business School's Entrepreneurship Organization. It's great to see you all here today, and it's my pleasure to introduce Ynon Ravid. He's the co-founder and co-CEO of OpenFolio. It's an investment community that uses transparency to improve investment-making decisions. He's a Columbia alum where he studied economics and computer science, and before founding OpenFolio, he worked as an economic consultant and then as a high-yield bond trader for 6 years at Oak Hill Advisors. Enjoy.
Hey guys, can you hear me okay? Great. Thanks so much for having me. It's actually awesome to be up here. It's my 10th year reunion coming up, and a little bit of nostalgia just being up here. So excited to be here. So really the few things I want to talk about today are the OpenFolio journey and sort of how we got where we are, what we started with, and how we got to where we are today. A little bit about making the leap from traditional finance to the startup world. And then just a tiny bit about the speed of innovation we're seeing both in the tech space and in financial technology in general, and how fast that's accelerating and sort of where we are in the cycle. So the OpenFolio journey began about 2 years ago. I studied econ and computer science here at Columbia, and after that I left to work on Wall Street trading high yield. And as I was doing that, what I realized through the process is that it was very difficult to make my own investments. I knew all about high yield, but I'd always ask the question, what should I do with my own money? And actually my best friend from Columbia, Hart, who couldn't be here today, worked at Goldman and had the same question. What should we do with our own money? And it wasn't that we wanted some stock tip or the next new idea. It was, what are you doing in your 401k? How invested are you? Are you looking at any new services, say Betterment, or using a financial advisor? And so what we set out to do when we started is, can we build a service where people can automatically share what they're like as investors, all in percentage terms, no dollar amounts, and sort of see what comes out of that? The first questions we got was, you guys are nuts, nobody's ever going to share this. But then once they do, what do you do with it? So step one was share this, and lo and behold, people shared it because it's just in percentage terms. And then the question is, we have all this data, and what do we do with it? What do I do knowing that, hey, my friend owns 20% in technology, or that Warren Buffett owns 30% of his portfolio in Wells Fargo? And what we realize when you take all that data is that there are trends that arrive and that you see very quickly. You get to do things like compare yourself to the average investor, or compare yourself to, let's say, somebody in your age group, or somebody in your industry, people in your financial situation. I can open up an app now and say, hey, how am I doing? How do I compare? Am I paying too high fees? Am I over-allocated? Am I over-concentrated? In the past, it was always sort of a judgment. Somebody told you you're doing this right or wrong. What we wanted to do is build a place where it's not a judgment, but here are what people are doing, here's where you stack up. And from that really was born the mission of OpenFolio, is a community that helps people make better investment decisions. And so what we've seen from that is this way of coming up with new decisions, this social validation is a great way to take action. Just go back to the example a moment ago. When somebody tells you, hey, you are too concentrated in your portfolio, you say, yeah, sure, I know that. But if somebody tells you, hey, you're underperforming relative to the average investor, fact. This is how concentrated the average investor is, fact. This is where you stand. They're all sort of fact. It's non-judging. Do with it what you may. We found that that's a great way to get people to take action and build a much more responsibly allocated, much more long-term vision for their portfolio. And so that's really where the business is going, is using a community and using social validation the way all other industries have sort of used to get people to take intelligent action with their investments. So that's that bit. I obviously can talk about it forever, but I'll keep it short. On making the leap from finance to a startup, when I left Oak Hill, it really explained or pinned as this like big nebulous leap. You're leaving the stable industry to go to a startup. And what you quickly realize, I remember my old boss used to always say, all businesses are the same. We all have customers, we all sell things, and we're all trying to grow. And at the end of the day, it's really true. And if you just remember that it's not a nebulous leap, you're just in business again. You just don't have 100 people around you. You have 5 people around you, or 2 people, whatever it is. And I think that's helped more than anything else in focusing on the work, focusing on where OpenFolio is going. The second thing, which was really disarming and unrelated, is how willing people are to help in the tech community. So the financial community is pretty closed for a variety of reasons. There's no building in public. There's no get coffee with a guy who's going to decide to spend the next 6 hours pushing code with you. And that is rampant, for lack of better words, in the tech community. It's pretty awesome. If for nothing else, that's reason to get into the tech business alone. This concept of sort of building in public and helpfulness. And the last bit, really I wanted to touch on in my experience is where we are in the cycle of innovation in the financial technology space. And I think that's one of the more interesting pieces of what we've learned. Putting financial technology aside for a second, just the tech stack in itself. You know, I took about an 8-year hiatus between writing code in college and, you know, deploying code with OpenFolio, and a lot's happened. You know, OpenFolio doesn't own any servers. We don't have an IT guy. We don't have any security. Instead, we deploy all our code to Heroku, which does all our system stuff. We have about 1,000 hackers that hit our site every day and submit bugs that we pay them a bounty on when they find something good. We own a couple Nerf guns and MacBooks, to be honest, and it all just sort of runs out there. And that allows for a totally new wave of rapid innovation. On the financial side, we've sort of seen 3 key themes. Some of them are tech-related. The first really is driving, I think, all this stuff is there is a $20 trillion wealth transfer coming from the baby boomers to the millennials. And everybody is furiously innovating to figure out ways that we're going to invest in the future, because we're not going to invest the same way as our parents. So I think that's one of the biggest drivers. The second bit that's powering our business, I think a lot of others, is execution costs are falling rapidly, both from free trading to transaction costs to payments. All this is dropping so quickly that people can really start to focus on the advice side of the business and other pieces. And then lastly, and what's affected us the most is when you go and start a financial business, if you started one 15 years ago, you built it all from scratch. Today, you can actually build on top of services. So when we think about OpenFolio, you know, we have a watch app that's actually launching today with the watch when you get chipped. And it shows you your performance in real time on your wrist and lets you compare to the average investor on your wrist. And what goes into that, we don't get pricing data from the exchange. We hit Xignite in the Amazon cloud to get pricing data. We aggregate your portfolio using one API that hits everybody. We're going to be able to let you trade in your account and change your holdings with an API that hits all the brokers. We don't have to build all these services from scratch. We get to build on top of all these other services. And that's a really wonderful layer. It lets you find the invention you want to make and not focus on all the things that need to go into it. That's been really one of the biggest drivers in letting us innovate. And that's really our landscape, the journey, making the leap, and all the technology and all the secular trends that let us do what we do. So really great to be here. Looking forward to meeting a bunch of you, and thanks for having me.
Now, continuing with the theme of financial technology, we're bringing on a great panel for you guys. To lead the panel is Kayla Tausche. She's a reporter on CNBC's Squawk Alley, where she focuses on the big money backing technology. She also reports across NBC properties, contributing to MSNBC, Today, and Nightly News with Brian Williams. Enjoy.
Thank you so much for that nice introduction. We have such a fascinating panel. Professionals who really cut across every part of the financial industry. On the end here is Matt Harris. He's a managing director at Bain Capital Ventures. Matt has service on the board of Build Trust, Chrome River, and a bunch of others. Successful recent exit of On Deck Capital, which raised $200 million in the public markets in December, I believe. So certainly coming at this from the private equity and private financing angle here. Barry Silbert, you may know from founding Second Market. As of last summer, you ventured off into a new unit called the Digital Currency Group, where you're focusing primarily on Bitcoin. Exciting road ahead. And then we have Maria Gotch, who's president and CEO of the Partnership Fund for New York City. And lest I butcher what you do exactly, Maria, maybe I'll just let you talk a little bit about how you spend your time focusing on innovation, especially in the financial world here in New York City.
Sure. So we're a nonprofit economic development fund focused on creating jobs in New York City, and our money comes from the corporate sector. And within the tech space, we're focused on trying to catalyze the growth of new tech sectors that we think should be in New York, but are not as strong as they could be or should be. And in particular, one of New York's big strengths is the deep concentration that we have of large corporations who are customers, who need innovation, want innovation, and have cash to buy it. So we run a series of programs that are about connecting emerging technology companies to large customers in financial technology, digital health, and fashion retail tech.
You recently also created the FinTech Innovation Lab in the city. What drove you to do that, and what sort of innovation have you seen in the FinTech space since creating that?
So we launched it 5 years ago, and we launched it because we sat in a room with 6 bank chief technology officers, and we asked them, where do you go to look for and buy new technology? And every single one of the 6 said, oh, California, Boston, maybe London. Nobody said New York. And so we thought, that's sort of ridiculous. Here we have a great tech sector, so let's try to build some companies that can sell products to these guys in their backyard. And they were happy to stay off, airplanes. And so the kinds of innovation that come into the FinTech Lab tend to be more core infrastructure and really get to how a bank is running its business or interacting with its customers. So everything from improving the mobile experience, so you can actually not have to peck with your big fat fingers on little tiny screens to move your bank balances, to open source storage was another company that came through, to some cybersecurity and compliance tools.
Barry, you were at an investment bank several years ago when you got the idea to start Second Market. Talk about being an entrepreneur and taking the leap to start a company in the financial services space.
Yeah, I guess after doing banking for 5 or 6 years, I realized that my soul was starting to shrivel away. Number one, no offense to any bankers in the room, but the truth is once if you feel like you're an entrepreneur and you have that kind of instinct in your gut, as soon as you have an idea that you think worth pursuing, nothing can really stop you. So it was great being a banker. I learned a lot. Totally overpaid for 5 years, and then I was able to start a company that I think had a pretty transformative impact on the way that private companies access capital and grow up and ultimately avoid going public for as long as possible.
Matt, talk a little bit about what you're seeing in financial technology and financial services, given that you came from the private equity world and now you've been in Bain Capital Ventures. But what sort of trends are you seeing, and where is innovation coming from in the space?
The way we think about financial services innovation is across payments, lending, capital markets, and insurance. So those are sort of the 4 subsegments. And the story of the past 10 years, before 10 years ago, there really wasn't any venture capital in financial services. It was like less than 0.5% of the industry. It's now over 10% of the industry. The big driver was payments to begin with. Companies like Square and Stripe and Braintree waking the world up to the fact that entrepreneurs could compete with traditional financial institutions in markets like payments. I would say where we are today is that the hottest area is lending. So of those 4, we're kind of on the second chapter. Companies like Lending Club and On Deck and dozens of others in every category of credit, again, realizing that they can compete with banks in this particular case as it relates to all sorts of different loan products. And so we see investing in capital markets coming up next pretty strong, and then finally insurance is taking a long time to get disrupted, but it's sort of inevitable.
On the advisor side as well. Right?
What's that?
On the advisor side as well, the robo-advisors, the wealth fronts.
Yeah, so within capital markets and investing, you've got wholesale and retail, and within retail you got products like the Bitcoin Investment Trust would be an innovative investment product. Most of the action is retail, financial services, advisory. So Wealthfront, Betterment, SigFig, those companies, essentially disrupting the wirehouses and financial advisors who effectively for years have been charging a lot for not outperforming the market. So again, there's heat all over the landscape relative to the good old days when I kind of had it to myself. But rising tide lifts all boats, and it's certainly a very exciting time to be in space.
You talk about the first inning being retail financial services. That would be natural because it's easy to market, it's easy for customers to understand. Now getting into capital markets, getting into lending, what are the challenges posed by delivering and building a more complex product that probably carries a lot of regulation too?
Yeah, I'd like to say that it's very hard to build a so-called full stack fintech company, because as a practical matter, you can't do everything that you need to provide a full lending solution or a full payment solution or a full investment solution. The government won't let you. You need to have a bank, you need to have a broker-dealer, you need to have a regulated institution at various layers of your business. So however transgressive these companies seem, generally they're in some form of partnership, with one of the banks that Maria referenced earlier. And so how and in what ways you can use that to your advantage and not have it be a crippling disadvantage is one of the key skills of any kind of fintech company.
Maria, do you think that it's that prospective regulation that has made the fintech and financial services space for a while less popular than other sectors for innovation?
I don't know if it's less popular, it's certainly harder, right? If you're trying to sell to a large bank or deliver a financial services product because of the regulation. Financial services is about money, and that's very high on people's list of things they want to steal. So you have to have security that's very tight. You need to have a fiduciary responsibility around money. And so what the regulators are now doing is they are extending the requirements for security, data privacy, the ability to produce information back to the regulators, all the way down the vendor chain. So it's no longer the banks that are subject to all of that stuff. It's actually their whole vendor chain, which includes small tech companies. So when you have a tech company that walks in, and typically everybody builds their thing on the Amazon cloud, and they walk into a bank and they say, hey, we've got this great product. The bank thinks it's really interesting, innovative. And then the question is, so the bank says, so where's our data going to go? And the tech company says, oh, we work on the cloud. And the bank says, not with our data. So you have a number of these sort of friction points where regulation and fiduciary responsibility requires you to do one thing one way, and the tech companies used to doing it another way, and it takes a little bit of time to build that bridge between the two. So it's as Matt said, regulation plays a part, but I don't think that means nothing happens. And I think the model of life sciences, you have big pharma and innovation with biotech companies is one you're starting to see in financial services. Small companies providing innovation and at a certain point partnering with a large institution.
And I guess it's less regulation, but on the legislation side or legislative side, the Jobs Act, which was passed into law, maybe 2-3 years ago now, has actually had a pretty meaningful impact on both kind of the IPO on-ramp as well as enabling companies to stay private longer. But the one piece that I think got the most press actually isn't even finalized yet, and that's crowdfunding. And for those of you who are familiar with kind of the model, it's kind of Kickstarter, but instead of buying or pre-buying, whatever, you're getting equity. And this is an area that I think people are excited about. I'm philosophically supportive, but it's going to be a major disaster if and when it actually becomes legal. And it's the biggest problem that I think that whole industry is going to face is ultimately going to be adverse selection and lack of liquidity. So the best ideas tend to get funded now through either networks of angels or early stage seed investors or platforms like AngelList. The ideas that get posted up on these platforms, which even if they are having their financials audited and put up for the public to see, typically it will be situations where they've missed or gotten passes from other investors. But really more importantly, and the thing that no one really is talking about is the lack of liquidity. So anybody here who has angel invested knows that you're lucky if you get any money back within 5 years. It's probably more 10 years. And the types of companies that will raise money on crowdfunding platforms are likely going to be ones that are never going to go public. They're likely never going to get bought out. And so what we'll see is a lot of money flowing into a bunch of companies. Some jobs will be created, which is great, but ultimately you're going to see 3 to 5 years down the road a lot of really upset investors asking where their money is.
It's an interesting point that you bring up because there have been so many conversations about the current environment for fundraising. And Matt, I know that obviously you would love to have this whole industry to yourself, as you mentioned earlier, but what types of companies do you see going to private equity for funding? What types of companies do you see going to venture capital, going to hedge funds, going to mutual funds later stage potentially? And what types of companies do you think crowdfunding might actually be the right route for them to pursue?
Yeah, certainly the single biggest influential vector there would be size. So we're seeing mutual funds and hedge funds very active in later stage FinTech companies, and they tend to be less price sensitive. You know, they're sort of generally used to buying public company stock, and so if they can buy it in the private markets for 20% cheaper, they're fine with that. Whereas the private equity and venture folks kind of like to see more of an uptick between when we buy and when we take it public. So that's made life a little more complicated at the very later stages. What we see on the crowdfunding side in these early sites, sort of pre-finalization of the rules, they tend to be more consumer products and consumer services. So it's less deep tech, it's less sort of esoteric concepts, and it's more things the retail investor can understand as a consumer, and they sort of buy what they know, they buy what they can understand. I generally agree with Barry that you know, it's not going to produce the next Google probably, and in fact it's kind of weird that our government, which is generally trending towards regulation and consumer protection everywhere else, is saying it's okay for my grandmother to buy stock in a startup, but I guess consistency is not something we demand of the public sector. You know, maybe, you know, let 1,000 flowers bloom and one of them may grow to be a tree, I guess, but I do see, similar to Barry, complexity there. The real sign of the apocalypse, from my perspective, the thing we saw in 1999 and 2000 that ended so badly is when you have early IPOs. So the one thing that keeps me from being really concerned about the state of play is that companies are, in general, taking longer to go public. They have hundreds of millions of revenue, in many cases profits. They have a viable business model. If that time frame shrunk, we started seeing sort of speculative IPOs. You know, we used to have like 5-10 IPOs a week in the late 90s. We're not seeing anything close to that. So that's what that would be the last thing, I think, keeping us from the kind of bubble type behavior that would be concerning.
Given the proliferation of all the lending platforms, you know, the lending clubs and the Prospers, how do those guys perform when if the economy turns?
Generally not well. I mean, it depends on the type of assets they're creating. So, you know, these companies are effectively loan originators, whether like in Lending Club's case or Prosper's case, they're originating an unsecured consumer loan. Or in the case of an On Deck, it's a small business loan, or in the case of SoFi, another scale platform, it's a student loan. Those things have very different performance characteristics in a credit crisis depending on where they are in the payment priority. In other words, do you tend to pay those things back or other things? And depending on the duration of these loans. So at On Deck, we took some comfort that our average duration was less than a year so we could react well in a crisis. I think at SoFi, they should take comfort that people generally don't stop paying on their student debt because it's not dischargeable in the event of a bankruptcy. By contrast, I would say Lending Club and Prosper, with their unsecured personal loans from a non-bank, people are probably going to pay their auto, their mortgage, their student, their credit card debt before they pay that. So I would say, you know, if you have a 5-year piece of paper of that type, that might be something to be concerned about in a credit downfall.
Lending Club was founded before the last financial crisis,
Yeah.
so the company would say, well, look, we've already had our business model tested by one crisis, but they didn't necessarily have the amount of assets, really, that they do today, or the amount underwritten that they have today. I'm just wondering, as the size of these loan books grow, are you seeing the underwriting standards depreciate, or are you seeing them stay high quality?
Lending Club is a very high quality company with a real emphasis on risk and credit. I have not seen their standards deteriorate. And in fact, what they're doing smartly is getting into other asset classes where I think they can be more differentiated and therefore take pressure off of the need to grow their unsecured book. But what concerns me is that they have competitors who are less, you know, savvy. And lending is one of those businesses where a dumb competitor hurts you worse than a smart competitor. If you're selling software, you'd love to have a dumb competitor. Your stuff will be better. If you're selling money, you really don't want people out there giving it away cheaper or giving away money with less sort of credit standards. You just end up shrinking your market share. So I do worry about the competitive dynamics. Again, not so much Lending Club, which is an excellent company, but their success has drawn lots of Me Too's, and that's not generally a good thing for the credit markets.
Maria, I'm wondering what you're hearing from Wall Street, which is such a huge part of the economy here in New York City, when companies like some of the alternative lenders crop up and really try and eat the lunch of the banks that, for whatever reason, aren't lending to the consumers who have been the source of much of those loans. How does Wall Street respond?
They're all interested in innovation. So just as one data point, when we started the FinTech Lab, we had 10 financial services firms who partnered with us. We're now at 21, and we're sort of turning people away, just from a capacity perspective. So and I would say this has happened in the last 2 years, the sort of the wake-up call in a big way. So they all have innovation groups. A number of them are going back into investing, whereas after the financial crisis, 2008, a lot of them really pulled back from doing principal or venture investing. And I would say most of them are back, or they're back in a much bigger way than they used to be. And they're starting to make some acquisitions. I would say there were probably more, there was sort of a first wave of FinTech in New York where there was a bunch of sort of trading platforms that got developed in the late 90s. Many of them got acquired. I don't think we've had that same level of M&A, although it's starting. So there's a innovation team internally, there's dollars being invested, and then there is starting to be the beginnings of acquisitions and M&A activity.
Yeah, I'm seeing something really interesting starting to happen. And that is that the resumes are starting to fly out fast and furiously from these places. I'm inundated with resumes from people who work at these organizations who are either sick and tired of having to deal with this regulator or that regulator, or frankly are looking kind of across the street and see some really cool startup that's doing something that is going to impact their business, and they can do nothing about it. They're just kind of sitting there and watching. And finally, thanks to investors like Matt and Bain, there are companies that are getting funding where they can afford to hire some of the best talent out there. So I actually think that we're not going to see a whole lot of innovation coming from Wall Street over the next 10 years, and it's going to be some well-run, well-funded startups, hopefully all here in New York, that are going to be eating their lunch.
Matt, we were having this conversation before the panel started about JP Morgan's annual shareholder letter. And last year, the CEO, Jamie Dimon, called PayPal, among other competitors, shadow banks, saying that because they did not have to pay the regulatory costs that some of the big banks did, that they were able to disintermediate some of their businesses, offer certain loans and certain products for a couple basis points cheaper. But there are still some advantages to being a large institution. And I'm wondering if you can talk about the difference and how the breakdown has sort of developed since the crisis.
Yeah, I think the banks face real constraints around the kind of innovation that we're talking about here. It's actually less intellectual constraints. I think they get it certainly more than at any time in the last 20 years. They get that there are threats, and they actually understand them pretty deeply. It is not a head in the sand phenomena, but the checks on their behavior from whether it be their capital, which I don't think the government wants them spending on speculative acquisitions, or their expense structures, or the regulatory and compliance burden that they face, really inhibit them from keeping up, even though they're inclined to and even though they're paying attention with the startup activity. That said, the regulators have been very clear that they, A, believe that every financial transaction should be regulated, and B, they only know how to regulate banks. So I think if you just follow the syllogism, there will be a bank in every financial transaction in the United States. There's not going to be a shadow economy. PayPal owns a bank. All of their dollars are stored in a bank account. There's a bank in every transaction, and that's not going to change. So I think Jamie Dimon has to be thoughtful about how much technology he wants to build to delight his customers, which I would submit they're not that good at, and they're probably the best of a bad lot, and how much he wants to be an infrastructure provider to the people who are good at building customer-facing small business facing, even enterprise facing tech, resting secure in the knowledge that there's going to be a bank everywhere, and he should be working on making sure it's his bank.
And even on the infrastructure side, they're dealing with, in many cases, 30-year-old infrastructure, right? So this is they're not on the public cloud. So there's any number of things that they have to contend with on a day-to-day basis, and that actually those are all barriers to innovation. And so I think I agree with Matt that it's less about knowing that they're going to come up with all the great innovations, but it's more on the partnering side that they're going to do that. The other thing that they're all facing is the need to reduce costs. And so from an entrepreneur's perspective, that's actually a very interesting opportunity, because this idea of each bank, certain things used to be a competitive advantage, and each bank did them. Now with the new cost structures, there's a whole series of conversations around, you know what, not a competitive advantage, it's just a cost, we want to move it out and put it in some sort of shared services model or buy a service from somebody else. So it's, from an infrastructure perspective, I think that is an area, I think, Matt, you said you're starting to see innovations as well, but that's sort of the next, been a lot of buzz around payments, but I think this is the next frontier in terms of where people should be looking for opportunities.
We are seeing banks maintain venture capital arms internally. Do you view those as their hedge or their insurance policy against any potential competitors?
I think it's a combination of hedge, but it's also market intelligence. They can see what's going on. These might be pipeline innovations for them to bring in at some point. So I think there's and then maybe they'll make money, right? So I think it's a combination of why they do it.
Yeah, it's a weird psychological device in many cases where the level of cognitive dissonance in these banks where, okay, they've acknowledged that they can't build it all. So they're going to partner with startups. And then they say to themselves, I'm going to make those people so rich, I can't believe it. I got to at least own a piece of it. You see them go through this tortured analysis of there's going to be economic value created here.
It's our data.
It's our data. These are our licenses they're using. So it's their way of kind of sleeping at night, knowing that this value is being created. Yes, it's not within their bank. Yes, but they can at least own 10%.
One of the areas of innovation that we've seen a proliferation of companies in the last year, Barry, you know well, and that's in Bitcoin and digital currency. Walk us through the landscape and where we've come in the last few years as Bitcoin has continued to be volatile, but yet there are people who really believe in the infrastructure around that.
Great, my favorite topic. So, all right, so I'm going to do my usual audience poll.
I'm going to put my mic down for 10 minutes.
So, okay, so I'm going to poll the audience. So on the spectrum of Bitcoin skeptic to Bitcoin believer, and I want to see everybody put their hand up. If you are a Bitcoin skeptic, put your hand up. Oh, this is a hostile audience. Okay, who's a Bitcoin believer? Oh, okay. Maybe it's
Still, at a university event to be outnumbered.
Yeah.
Who's a believer in the Bitcoin infrastructure?
See, this is the thing. So this is the thing that cracks me up. And as much as I think she's a fantastic investor and knows.
As much as I love Barry, it's Friday afternoon, so the gloves are off.
So this is the funny narrative that's emerged, and that is that. Blockchain technology is going to kind of change the financial services space. It's great. We love it. But Bitcoin is meh. Bitcoin, the currency, who needs it? We don't want it. No, I would remind everybody that 12 months ago, everything was meh. So the fact that over the past 3 to 6 months, you have the CEOs and CTOs of major banks all capitulating and saying, you know what? Maybe those Silicon Valley guys are not that crazy. It means a whole lot. But the truth is, the reason why the Bitcoin technology, the reason why the blockchain is as powerful as it is, and the reason why people are so excited about it is because it's secure and it can process large amounts of transactions. And the reason why it's secure and the reason why it can process large amounts of transactions is because there's a financial incentive built in for thousands of miners around the world to dedicate time and energy and resources and money to mine Bitcoin. If you eliminate the financial incentive, no one will mine Bitcoin, which means you don't have a secure ledger, which means you don't have transactional power. So and mark my words, I don't know what today is, April something or other, within 6 months, the narrative around Wall Street is going to be blockchain is good, oh, and you know that Bitcoin thing, it actually is something you may want to actually own because it's going to go up in value if we're correct.
You say that's going to happen within 6 months?
It should, I mean, most people, it takes about 12 months to get Bitcoin. And if people are now saying the technology is good, it won't take very long for them to realize that the currency itself is the fuel that you need to power the engine.
I remember when Bitcoin, I believe, hit its peak, and it was around the time when Cyprus, its economic viability was in danger, and depositors had to take a haircut on money that they honestly had been keeping at the bank. And there was a sense that maybe having a currency that was tied to a central bank was not a good thing. And that's when people started to really take a close look at Bitcoin. But then they started talking about the Cyprus situation and saying, well, it's a tiny economy, it's a speck on the radar, and while this is good in theory, maybe it doesn't have that many applicable real-time uses.
Yeah, and it's amazing how quickly certain people in the press turned on Bitcoin. I'm not saying that you did this, but you know, for 2 weeks' time, it was the hottest story on CNBC, and you know, I got
2 weeks, that's a long time, 2 weeks.
right. And you know, it was the new hot shit, and then it basically faded away, at least from kind of from a news perspective. And it's just funny to me that people think that something that has such a big idea. You know, what Bitcoin is, it's a new form of money, and it's a new way that people will be able to move value around the world and bypass all of the middlemen and the friction points that exist. And anybody who has sent money to your family overseas, who's wired money overseas, who has tried to, you know, exchange your money somewhere else in the world, just realizes that the system is broken. And look, ultimately, I'm a firm believer that Bitcoin as a technology, as a currency, is either going to change everything. It's as big as the internet, it's going to change the way that people think about money, or it's going to fail. And something else will likely emerge to take its place. And you know, the numbers are staggering. You're talking about hundreds of billions of dollars a year that's being spent for people to basically just move what is essentially digital ledger entries on a system. It should not take any more than 3 seconds to send money to Hong Kong. It should not cost you any more than fractions of a penny to change your money from US dollars into euros, yet we're all being taken full advantage of by our existing financial system in time and cost.
Being an entrepreneur in this space, you have a good vantage point on what type of money is coming into this space. Is that part of a cycle? Have we gone from a point where it was speculators who were playing with house money, just trying to see where the value would go, to different types of investors at this point?
Well, so early on, so Bitcoin came around in 2008, 2009, and for the first couple of years, it was really all about kind of experimentation. You had Silk Road and people were buying drugs and doing bad things, but you had some developers kind of building products on top of it. But it really wasn't until 2011, 2012, you saw businesses being built. Then we saw venture capital get involved. And so venture capital in 2014, there was $330 million invested across a bunch of companies in the space. That was 4 times higher than the year before, which is off of basically a base of 0. But more importantly, in the first quarter of this year, there was $300 million invested in the Bitcoin industry by venture capital. So we're on pace now for $1 billion to be invested this year in Bitcoin-related businesses. And so if you look at the internet and the pace of money flowing into the space, from what I understand, we're kind of like circa 1994, 95. I don't know if that means that we have 6 or 7 more years of fun before the bottom falls out. But what I do know is the venture capital industry doesn't always pick the right companies, but they almost always pick the right trends. And the best venture capital firms in the world, Bain and Andreessen and Union Square and Excel and Index, they're all investing a lot of money into the space.
Matt, what would it take for you to write a check for a Bitcoin-based company?
We have invested, actually.
But you are a skeptic.
No, I raised my hand as a believer. I mean, it's nuanced, for sure. I think of it as a standards movement. Not dissimilar from most standards, like the internet was a standard. Like, can we all agree that we tune our computers this way? They can all talk to each other? Great. Many standards fail, as Barry says, because you really need to get over a certain critical mass before people even bother to pay attention to a standard. Bitcoin, by many measures, is doing quite well as a young standard. And if it does become a standard for financial transactions, the pie is enormous. So to me, is there a greater than 50% probability that Bitcoin carves out big chunks of cross-border transactions or other parts of financial services? There's not a greater than 50% chance. But if it does, the value creation is spectacular. So to me, on like what I would think of as an expected value basis. So 20% chance of winning, but if you win enormous. I'm in that game. I mean, I lose a lot, right? I mean, I'm comfortable losing. My investors are comfortable having me lose, but I can't not be in this game, because if there are big wins, and again, I think there are meaningful percentage chances of big wins, it's going to mess with a lot of the other stuff I'm looking at, and it's going to be really meaningful. So I think in aggregate, I am definitely a believer.
Regulators have been trying to figure out how to treat Bitcoin. The initial debate was, is it a commodity? Is it a currency? How do you peg it? Which agency would even regulate it, depending on how you define it? At least recently, we saw the head of the Department of Financial Services here in New York, Benjamin Losky, say that he would require companies to have a BIT license. And Maria, I'm wondering how you see the regulatory landscape unfolding for something like Bitcoin nationally or here in the state.
So that gets to a broader question about the disconnect between, particularly in New York, the regulatory environment and innovation. And we see this sort of in financial services, in people like Uber and Airbnb. You see it kind of across the spectrum, where you have regulations that have been written for 21st or 20th century economy kind of companies. And you've got these new business models, and they run afoul of something that technically applies to them, but like not really. So we're actually sort of, our parent organization does some policy work. We're actually focusing on it more from a policy perspective around how do you create a improved and streamlined dialogue between the regulators. So when you have new business models that come in, rather than, there's a conversation that happens towards the beginning of the process, so that the regulators can make adjustments that are needed, so that everybody doesn't have to spend time in court unwinding, you ran afoul of this law and hire a bunch of lawyers to defend you in court. So it's an issue in Bitcoin, but honestly, it's an issue we see it across a multiplicity of industries, because innovation, the pace of innovation has happened, the pace of innovation has increased, and the pace of regulatory change has not.
Just on this topic, one of the really healthy things we're seeing is that the regulators are shifting from thinking about Bitcoin in and of itself to saying, okay, Bitcoin is now being used for things like remittances. How do we regulate Bitcoin as it's used to solve a real problem? And this is, again, like, it can be frustrating for people who watch this and wonder why it hasn't happened already. But this is a multi-year cycle, so it's huge progress. That that the debate has moved away from is it a currency, is it a commodity, is it neither, to Bitcoin, in Barry's instance, it's being used to move money from here to the Philippines in a remittance transaction. Well, remittances are highly regulated. The government has a strong point of view that it should know when money's being moved overseas, exactly from whom, to what amount, and for what purpose. And so the government entities, and Losky's been a leader here, are saying, hey, we kind of know how to regulate remittances. Let's take that body of work and think creatively about how it applies to this new technology. I view that as an enormous intellectual advance, and what will be an enormous contributor to Bitcoin's likely success. It's just not happening quickly, and it's not going to happen quickly. This is years, but what we're seeing is progress, I guess is what I'd say.
Barry?
Yeah, I when I got involved in Bitcoin in 2011, you started telling people about it, and the first response was, well, the government's going to shut that down. Everybody, that was their reaction. And I probably, thought that initially, and then you kind of come to appreciate two thkind. One, you can't really shut it down. I mean, it's not really, there's no company you can, fine, or nobody you can put in jail. I think, kind of really more importantly, it is, it's such it blurs the lines between technology and money and currency and all these different things. And when you have such a unique concept like this, and I've run a regulated company, that being Second Market, for 9 years, regulators don't move fast. In fact, they move whatever the opposite of very fast is they do. And so as you're thinking about it from a US regulatory perspective, I actually think regulation is actually Bitcoin's number one advantage relative to the existing incumbents. Because look, these startups, the ones that are well-funded, they're hiring smart people, they're hiring smart lawyers, and they're going to figure out a way. And innovation and a little bit of elbow grease is going to enable these guys to kind of beat the incumbents. And what's happening, which is really interesting, is here in the US, you have a competition that's going to form between New York and California as to who is going to be the capital of this new industry. That wasn't happening 12 months ago. And globally, you now have countries like the UK and Germany that are saying, well, hey, we're Bitcoin friendly. If New York doesn't want you, you set up shop here in London. And London's doing a fantastic job attracting a lot of startups and a lot of capital. So yes, Russia has banned Bitcoin, and China has banned Bitcoin, and Venezuela has banned Bitcoin. But I'll bet you that when India decides what regime they're going to follow, it's going to be the UK or Germany, and it's not going to be Russia or China.
Yeah, Russia and China ban a lot of things, so yeah.
And yet, actually, activity is at an all-time high in both countries, of course.
Very interesting. Not to spend the bulk of our conversation today on regulation, but because it is the defining factor of this industry today, I'm wondering, Maria, does regulation make innovation impossible in any specific sector of the financial industry? Is there a corner where it would be impossible to build a new product to disintermediate a system that's already there because it's so heavily regulated?
No, not impossible, but what it does is it just makes it a longer process, which means you need more, so if you need more time, you need more money. So there may be, opportunities where you say, I'm going to pursue the consumer-facing side or consumer solution because that's faster to market, and so things don't get done. But I think it's more of an issue of not regulation getting in the way of it. It's impossible. It just makes the whole process longer, so therefore people choose not to do it.
Yeah, if you'd asked me 5 years ago, I would have said the two things that aren't really doable would be creating a scale insurance carrier. So you can try to sell insurance, but if you want to be like an insurance carrier, state regulated, huge capital requirements, no one's going to do that. And trying to be a new stock exchange to compete with a very disciplined duopoly, no one's going to do that. And here in New York, we have two companies. One, Oscar Health. From scratch 3 years ago, they have a $1.5 billion health insurance carrier. The company's doing $300 million in revenue this year. It's an unbelievable success story. And we have IEX, which again, from a standing start 2.5 years ago, has 1.5% of U.S. equities market and is triple where they were last year. So I agree there's nothing left where you'd say it's absolutely impossible to compete. Both those companies have taken time and money, but not that much time and not an outrageous amount of money.
The amount of funding that Oscar was recently able to raise was fairly eye-popping to a lot of people who weren't familiar with it. What was that, 145 million?
On top of an existing 100 they've already raised. So again, it's not cheap, but at a $1.5 billion valuation, it's not that dilutive either.
What do you think that company did to be able to overcome the hurdle? Just think more creatively, just tackle something that was complex?
Obamacare.
Yeah,
the regulatory scheme in the world, in the United States, changed, so they took advantage of it. So I think they just saw a big change, and there was an opportunity, and they went for it.
Yeah, first it was just the courage. I mean, Obamacare was 3 years coming, and then the implementation, it was sort of well telegraphed, and yet they're the only ones. So I think it was not like a gold rush moment. They're the ones who had the courage to raise the capital. I think they went through $30 million of capital before they were in business, before they even knew if the regulators would let them. So that takes some charisma and a great business plan. And they had a great regulatory strategy. I mean, they camped out on the New York State regulators, and they said, do you think consumers in New York should have more choice in healthcare and in health insurance? And they made the point over and over again, very persuasively, that there was a hole in the market that they could fill. And they won. And it's as simple as that. So I think it is both a cautionary tale because of the capital intensity, but it's also extremely heartening, I think, to know that again, there are no corners left of this thing that aren't open to entrepreneurs with sufficient courage.
Do you see this being replicated, Maria, elsewhere in the insurance industry? Life insurance, perhaps?
That was the softball question to me, thank you. So I just wanted to make the point for the audience that I've met in the last 6 months with 4 major insurance companies who've seen what we're doing with the FinTech Innovation Lab. And we actually have 2 of them in the program, but these are 4 others who've come looking for innovation and they're not finding it. So I met with one yesterday and they said they've been to the West Coast and they don't see, and they're in the life insurance business, and they're not seeing innovation. So for those of you that are entrepreneurs and can grab an insurance broker, have them explain to you, because there is an interest. It was 4th on Matt Harris's list for a reason. But there is a hunger and an interest. They understand that they are going to be disintermediated and new business models are coming, because theirs is about 1,000 years old. So it's an area that, again, is highly, or if not more regulated than the banks, but they recognize that there's opportunities for innovation, are looking for it, and something you all should take a look at if you want to go into that sector.
If it's true, Maria or Barry, feel free to take this one. If it's true that Visa and MasterCard are the incumbents in the payment space and will be going forward, what type of technologies do you think would be useful as bolt-ons to the networks that they already have for people in this room who are thinking about building a payments platform?
Well, I'll not answer the question, but say something hopefully insightful.
The answer is Bitcoin.
So outside the U.S., and the latest numbers I saw, some large percentage of the world doesn't have credit cards. I don't know, do you know what the number is? It's like 70% don't have credit cards. I don't know what it is.
Oh, way higher.
Yeah, so outside the U.S., if you're in India or throughout Africa or Latin America and you don't have a Visa or a MasterCard or an American Express, this conversation is irrelevant to you. And I think what Bitcoin or these types of things enable is businesses to be built on top of a new platform that can provide a lot of the same services and value that people get from credit cards in a different model, and not have these incumbents that are setting the rules. Now, it's very early, of course, but we're seeing, I've invested through my company, Digital Currency Group, in 50 companies around the world, and about 1/3 of them are located in emerging markets where we're seeing some real dramatic increase in uptake in Bitcoin usage by both kind of person to person, but also merchant acceptance. Again, it's very early, and the numbers are still small, but I'm pretty sure that Visa and MasterCard, American Express, and Citi are not going to be setting up offices and branches in every town and city throughout Africa.
I'm going to just do a shameless plug for 3 graduates of the FinTech Lab. So they should incorporate Billguard, Dashlane, and Casisto. So Casisto allows you to do more mobile transactions with your device and whatever financial service you're using. Billguard helps you identify fraud and grade charges, and Dashlane is a more efficient way to enter your credit card information.
I actually think both answers are great. Barry's, though, was not actually off target, because Visa and MasterCard's mission...
Mine was.
Yours is perfect, but you didn't caveat.
You're an investor in Dashlane.
The mission in life for Visa and MasterCard is it's actually not to compete with each other, it's to compete with cash and check. And taking Barry's instance with barter and other forms of economic transaction. So if you want to get on their radar screen, find areas where they're not a significant percentage of the pie and show them how they can be. The example of consumer payments in emerging economies is the highest one on their list. The second, what I think should be highest on the list, is actually commercial payments in the U.S. So the commercial payments in the United States are 40 times larger than consumer payments, and they're still 65% paper check. It's a preposterous amount of money and set of behaviors. I mean, this is mail and a stamp and an envelope, and it goes there, and then it has to be opened and then taken to the bank and deposited. So if I'm Visa MasterCard, or if I'm a company looking to sort of skate to where their puck is headed and focus on commercial payments and thinking about how to turn all that paper flow into Visa, MasterCard, mediated transactions.
We have a few minutes left. I'd love to open up the floor for questions. If there are any in the audience, we'll give you just a moment to think about it if you do have. We'll go to you.
Hi. When you look at your crystal ball 5 years from now, what do you think is going to happen? How many of the banks are going to be completely disintermediated or gone, replaced by some of the large players like Amazon, Apple, whoever? And are there any other trends that you see that are going to be transformative in the industry?
So I think the answer is 0. There may be some banks that go out of business for business model purposes, but not, I mean, for just because they're poorly run. But I don't think they'll be completely disintermediated. And I guess if I had to pick a trend, I would say, this is a sort of a nerdy infrastructure answer, but I think you're going to start to see more of them on the public cloud.
I think that you will see banks disappearing, and it's going to be through a combination of, I think we have some global economic pain coming, which is going to result in some massive value destruction, write-offs, and I think you'll see some interesting consolidation, and I also think you're going to see some interesting breakups as well. It seems to me that kind of the one-stop shop banking model is on its way out.
Yeah, I mean, there's no doubt in my mind you'll see vast amounts of banks go away. We have 8,000 banks and 6,000 credit unions. And the one thing I think we can agree on is that local is way less important in financial services. So if you take that out of the equation, you really don't need that kind of swath of different companies serving fundamentally local needs, local deposit-taking needs, and local cash withdrawal needs. So I think that 14,000 goes to 2,000. I don't know in what frame, but it's going to be a disaster for lots of FIs. And I think more and more of us, every one of us will use a bank or a broker for everything we do. We might not know it because we'll be facing off against a company like Bank Simple or against a company like Lending Club or other application layer tech-oriented companies.
By the way, if you are a New York real estate owner that leases out your space to Chase and TD and Citibank around the city, I think you're going to lose a lot of money over the next 5 years. But that's my personal opinion.
Hi, my name is Mike Mazer. I'm a business school alum. My question is on data mining. Presumably, I think Bitcoin stops after about 21 million. So therefore, after that, what will be the incentive to process transactions? Is there a business opportunity there? And secondly, about the lost Bitcoins. I know I once found silver dollars under an old rug. So what happens with, apparently Bitcoins get lost. So is that lost forever, or is there a way to recoup them?
So there will be 21 million Bitcoin ever created. The last Bitcoin is expected to be created in the year 2140. That's again 2140. So we will all be gone. So it might not even matter the answer to this question. But at that point in time, built into Bitcoin transactions, you can incorporate basically a fee. So right now, miners make money by getting rewarded this what's called a block reward every 10 minutes on average. Over time, the market will determine what is the appropriate fee that should be charged for a transaction. So it's an interesting kind of free market experiment to see, can the market figure out what it costs to move information around the world. And then as it relates to Bitcoin being lost, I mean, it exactly is like that, where if you lose access to your private key, if you forget it, if you get hit by a bus, it's gone forever. So the 21 million is really it'll never get to actually 21 million. Interesting story. Some guy, I think in the UK, was mining Bitcoin pretty early on and had something like $10 million worth, and he threw away his hard drive, and it's in a landfill. And for a period of time, I believe there was they contemplated trying to find it. I assure you that if the price of Bitcoin goes up 100x, there will be just like people look for sunken ships on the bottom of the ocean, there will absolutely be scavengers looking for this hard drive in that landfill.
This is going back to the consumer as the investor. So with all these services out there, Second Market or the robo-advisors, peer-to-peer loans, you go back to old school stocks, how do you think the consumer ends up making decisions between all these services? How does the landscape, and obviously I have my own axe to grind on this given what we do, but how does the consumer actually end up In the old days, you picked stocks, you're a financial advisor. How do you decide whether or not you should put money in AngelList or in robo-advice or whatever it is? How does that end up looking, basically?
About 80% of my investing activity is B2B on purpose. I don't, of the things that have a crystal ball on, I would say predicting what I view as fundamentally a sort of a fashion decision about consumer choice is not my long suit. That said, the one thing that I bet on is transparency is going to happen. So a lot of consumer financial products and services are built on opacity. They're built on the vendor, the FI, knowing more than the consumer, and therefore charging a lot or giving them, in effect, inferior product that benefits the intermediary or the manufacturer in some way unbeknownst to the consumer. We've already seen that decrease, and I think that kind of goes to zero. I think what you get out of that is more people with beta strategies than pursuing ineffectual alpha strategies. Because the history of consumer wealth management ultimately has been ineffectual, overpaid management. So I think what we will see is less management. You get the market, and you get it cheap, with financial advice laid on top of that. So that would be, the things that I do believe. Who wins and how and by whom and for whom alpha is in effect generated, because there's going to be some of it, I'm less certain about that. Does that work with your business plan?
We'll find out. I guess really quick follow-up question. What do you think happens from the retail demand for things like P2P loans, which is a relatively, $5 or $6 billion have been issued, today, and it's all institutional bought. What ends up happening from the retail? Is there really demand for those alternative products?
There's clearly consumer demand for yield, and these have been inefficient markets, so you've been able to gain excess spread if you were an investor on Lending Club. That's narrowed significantly, and the product has gone out in duration, down in rate, expanded into segments that are less prime. So we don't know what the future holds for people who are buying those loans now. I don't see a fundamental expansion in self-direction amongst investors. I don't see it in the numbers that in fact people who are used to following advice are following it less. People who are used to buying manufactured products are buying their own off-the-run assets. Even though those things are theoretically available to them, I haven't seen some dramatic increase in that behavior.
All right, I think we are out of time for this panel. Thank you so much for a riveting conversation, Matt, Barry, and Maria, and for our audience for being so attentive and engaged as well. Thank you, guys.